Thanking you.
Welcome to Wall Street Beats. I'm Jeff Mackey. Here with Bakes, here with Bob Morris. We're going to talk stocks. Let's make some money, damn it. Bob, what you looking at today?
We're watching the oil price and what Trump's doing here and announcing yesterday that he's going to meet with Putin over in Saudi Arabia. They haven't set a date yet for it, but it's going to be soon. And that really turned the energy markets around yesterday. And it was interesting. We're sitting here watching all the energy stocks rip up early in the morning while oil prices are off a little bit. And then all of a sudden they took a U-turn right when the news came out that Trump had a phone conversation with Putin, was going to follow up with Ukraine, and that he was trying to negotiate a peace deal. And it came out that he's going to meet with Putin in Saudi Arabia sometime soon. They haven't set a date yet. That really put nervousness into the oil market in these energy stocks, the E&Ps, the integrateds. The swing from the high to the low yesterday on these names was 4 to 5%. Which is
and how's our follow through? Because we've seen a lot of moves from Trump lately, and it seems like one of the things differentiating this term from his prior efforts is that people are a little less apt to buy into everything he's saying. Canada's not changed its name yet. Maybe Google Maps will take care of that. But it's so he's going to meet in Saudi Arabia with Putin. I think they could go golfing. They might talk about human rights violations. Who knows what's going on? Like, how much credence are people giving to this? And is that really the prudent way to trade it?
Yeah, I think people are giving it a lot of credibility because they know he wants a peace agreement and they know he wants lower oil prices. And we've talked ad nauseum on this show about the whole drill baby drill theme is going to be hard to implement near term because all these oil companies are going to continue to do what's worked for them, which is return capital to shareholders. So we said, look, he's either got to get some peace agreement with Russia to lift some of those sanctions on their oil exports, of which Biden threw on some extra sanctions right before he left office. And either to get Saudi Arabia to increase production or get some bilateral agreement with other nations around the world to buy our crude oil. And so we know he wants lower oil prices. The fact that he's meeting with Putin in Saudi Arabia, I think makes people nervous. And as OPEC's supposed to increase production at the end of March, that's something that they delayed a few times here, but they're on schedule now to take up production at the end of March, put some of those curtailed barrels back into the market. And you can be assured that part of the negotiation here between Ukraine and Russia is that they get those sanctions lifted on their oil exports or their oil production. So these are all things that play into Trump's game plan of trying to bring down energy prices. And we've seen the inflation data this week. It's not good. And the biggest thing you can do to bring inflation down is to bring down energy costs, which flows through all parts of the economy. So I think right now people are nervous about oil. Oil's ended up down a good bit yesterday. It's down a little bit today. It's almost $71 a barrel. So it looks like it might want to go back below 60. But the bottom line is people are going to be nervous about stepping up aggressively on energy with this in front of them. We don't know what the outcome's going to be, but we know what Trump wants the outcome to be, and that's lower oil prices. So in the meantime,
and he's probably not going to stop on that. I mean, this is going to be a perpetual type of thing. It's Trump's never going to come out in favor of higher energy prices, no matter what happens. So what's stop on this? What's the target, and how long do you ride this?
He wants to get it with a 6 handle. I think 5 handle is too low. Saudi Arabia, OPEC, they don't want a 5 handle on the oil price, but I think Trump would be happy with it in the mid 60s, $70 a barrel. That brings down prices at the pump. You saw the inflation data yesterday. A good bit of it was gasoline prices up, I think, 4%. So that's the easiest thing he can do to bring down inflation is hit these energy prices. So I think the target is with a 6 handle. I don't think OPEC or Saudi Arabia want to see below $60 a barrel, but he wants to see it lower than where it is today. And we're focusing on the pipelines. And Williams reported last night, and they had a very good quarter. They raised their guidance for the full year. This is a name that we bought and recommended early last summer. It's up more than 35% since then. We put out a note in November raising our price target to 64, saying we'd add the positions below 55. We got below 55 yesterday, and the stock's doing very well here this morning. Remember, Williams focuses on natural gas and its infrastructure, and it's largely fee-based. So it's really not impacted by the oil price per se, and their business is doing very good. And part of the theme here is all these data center build outs, and the natural gas you'll need as fuel to fire up the energy for these data centers. And that's interesting. All these pipeline companies took a big hit on the DeepSeek announcement several weeks ago, and they've not really fully recovered that hit. And DeepSeek's not going to stop these data centers being built in the US. It's not going to stop the flow of natural gas to build out of these pipelines in the US. So interesting that they took a hit on that. They shouldn't have. Williams, ET, Kinder Morgan, those are all names that I'd look to buy into here. I actually added a little bit of Energy Transfer and Kinder Morgan this morning at the open, just because, in particular,
Hey,
Kinder
Bakes, let's
Morgan.
bring you in here now. I've never met a commodity guy who's not at least a little bit of a chartist, whether they admit to it or not. What are the charts telling you here as you look at these things?
Here's Kinder Morgan. I'll go right through them one by one. Kinder Morgan is doing what you would expect it to do. Yes, it had this gap down here. All the pipelines had this gap down here. Frankly, I can't recall the reason that day, but
It was that was the DeepSeek announcement, Banks.
Yeah, okay. So that I would something like that. That's Kevin Bacon, 6 degrees of separation kind of stuff. That's really a stretch. Now you also have seen the stock go from been a double over the last year. It comes back into this support area. I don't like the down volume picking up, but I'll give it a Roger Maris asterisk for now. And as long as it holds above the moving averages in this 26 or 27 level, Kinder Morgan looks fine. Phone home. This is nothing. You're just correcting into bases, and it's perfectly reasonable, logical. The yield isn't affected, which is why you own these things, I think. And Williams is like the granddaddy of them all. I'm really mixing my metaphors here, aren't I? Okay, so when the group looks the same as these do, here's the DeepSeek gap down, big volume, and now look at this one today. This is acting pretty damn well on 2 to 3x normal volume because it is the granddaddy of them all. This is a C corp, right? So you don't have the K1 nonsense, Bob.
Right, and they reported good earnings last night. That's the pop here today.
Okay, so this is doing exactly what you wanted to do. I just want to bring in a couple of things that we talked about offline, that the oil, it's all fund flows and portfolio manager getting yelled at for, no one's yelling at a PM for not owning oil right now. And I listen to people on the CNBC all the time say, oh, because we got our head handed, they won't say this, but this is what they mean. We missed NVIDIA. We're 600 basis points behind the S&P 500. So we're going to make it up by investing in energy because energy's cheap and and we think it's going to turn around. There's nothing going on in oil. Gas is acting okay. Pipelines are acting okay. But oil, I liken it to you slice your drive and it's going into the right deep rough. And as much as you want to lean left, you can't get the ball into the fairway. The ball and the market don't care what you think about oil. So I don't think there's much going on here. I like the pipelines with Bob. I like some of the gas names. And Bob, the Strategic Petroleum Reserve, is that getting refilled or is that too early?
We've been adding to it from before Trump came into office, but they'll continue to fill that. That's one of Trump's objectives is to refill the SPR. I don't know. He hasn't stated a timing to do that, but that's one of the things he wants to do also.
Thank you.
Excellent. Now, all right, Bakes, you had me. I was with you on everything up until golf as a metaphor because I simply never slice. So I understood what you're talking about with baseball. What else are you looking at? Tell me what else you're looking at, and let's see if we can.
I can use hook and leaning right if you'd like me to. It still works.
Sure. I'm familiar with the hook.
And so on the Tuesday show, I angered Burnout, not badly, but I wanted 2 of her names that she likes, and I didn't want to pile on. Oh, and Marson as well. Skechers, I don't like, and I didn't like it on Tuesday because it looks like this. Abercrombie and Fitch looks like this. It's rolling over. And so I saved my 2 shoe names for Thursday so I could anger Jeff, but at least anger him face to face. But it turns out we might be on firmer footing than we might have been. This is Deckers. This is a gap down on the earnings day. Clearly, they didn't like it. They took out the 200-day moving average. That nothing good happens below the 200-day moving average. It's like a nightclub at 3 a.m. Me, I would have sold a third here and start getting out of Dodge. I think you're going to have some feeble rallies, but they're going to be feeble because look at the volume down here. People are saying, you know what? I don't like shoes anymore. I'm Joe Jackson for the time being, and get me out of at least this shoe name. And then, I don't know if you want to stay here on Deckers for a while, or I want to.
We can't. It's what I noticed about Deckers, and kind of I follow the shoes as it's the selling has been relentless. It's you mentioned a bounce coming in. We haven't seen even a hiccup yet. This is down 30%, give or take, since they reported earnings. They just came in a little soft. The bar was extremely high, and they missed. But you know what? To me, that follow through has been just relentless. Abercrombie the same way. It's I had my kids. We finally gave up on it just because eventually you have to say, you know what, the chart's not completely insane, and I'm not going to ride this to zero because stocks aren't a suicide pact. And there's just no love coming for the space. It's even say Crocs. Crocs reported this morning. The results were great. That thing had been down in a straight line after we heard from Deckers. It's only loosely ready to shoot, but for all the strum and drang, and hell, I wish I was long it this morning, but unless I actually bought it last night, I'm probably still money down because it's just been getting assaulted day after day, and it only popped up to where the moving average was, and it figures to not punch through that today. I mean, what are you seeing with that?
Yeah, my sell, I sell when the 200-day gets violated, so that's back here at 112 or so. The 50-day goes down through the 200. That would have been my second sell. Let's call that 2, give or take, and then the 200-day turns down. So I'd be out probably, I don't know, call it 110-ish. I'm making that number up. I didn't calculate it, but this is it's an impressive dead cat bounce. The volume's pretty good. Obviously, they like the report, but you've got all these people that are below 115 that are saying, thank you, dear Lord, get me out of this. I want to take this off my sheet, and let's see how this closes. I bet you it closes towards the low of the day because of that dynamic that I just mentioned. But and his shoes are just they're not working. They're not working. And let's go find something else to do.
And they're not working for anybody. We were talking offline about Nike is not necessarily gathering what they spill. My favorite trade over the last year has been get long any of the shoemakers except Nike. That's done. To your point, it's the parade's gone by in terms of that tailwind that you're going to see. We've just got all the catalysts we're going to, and right now it's a show me story. Even On, which I remain long, but that's a long-term play. That's like a Lulu 10 years ago type of play where you're going to get the crap kicked out of you over and over again as they find their stride and people buy into the story. But just in terms of momentum, in terms of just we're going to gather this market share and it's going to be off to the races, it doesn't work in reverse. The weakness in the other shoe players does not mean that Nike's winning because they're not. It just means that they're now show me stories. OnCloud's going to be defenseless as a stock. They don't report until March 4th. They've already pre-announced pretty good results. So there's not much they're going to say. And man, this sentiment is just a beast on discretionary. The unloved discretionary is just getting the crap kicked out of it.
Which name is
On is
okay.
That's one of the big ones. It's about a $2 billion company. They're a huge beneficiary of Nike weakness because again, Nike's $55 billion, so they lose a little share. It's if you have Nike revenues go down 2%, that's potentially a 50% market share grab that is just out there. Hoka doesn't have to, or Nike On doesn't have to get all of it to have a huge move in the stock, and they've been riding that. I think that brand continues to work over time. But the stock, I'm not made of stone. You can see it got up to 69 there and it's been selling off pretty hard ever since. And it was really just it was a story of Deckers coming in and just taking the gas out of the market.
On is the best looking one. I like this the up volume coming back. So clearly at this support level of 50, there's buying interest that still is here, and it might be that On is gathering what the other shoe companies are spilling. Like maybe that's the play right now.
That's what I'm seeing, what my channel checks to the extent that it's little birds that talk to me and everything else. Is that Hoka's lost a little bit of a step in terms of grabbing that senior market share. The real driver for both those companies, Deckers is a big kind of conglomerate. They do Uggs and Hoka, and both of those have been benefiting from Nike falling apart because Nike really had a huge position in that in the high-end running shoes. Now you've seen New Balance, which is private. Their revenues were up something like 15-20% last year. On is taking share. It's everybody's just been gathered at the picnic. Now, what we heard from Deckers, Hoka was seeing a more promotional environment, that they weren't expecting the kind of growth that they saw last year. And that's a problem. What we saw from Crocs that people are going to be talking about when they say, do I buy this up 18%? Is you're still looking at a year that might go negative. They're counting on maybe 2%, 3% revenue growth. And that includes Crocs, the actual brand, doing really well. But the world is not just all about kind of rubber sneakers or sandals that you can wear with socks and look fabulous. It also includes the Hey Dude segment, which are boat shoes that no one really likes. And you add it up and you're still possibly negative for the year. It's a super cheap stock, But being cheap with declining revenue possibility is not going to win you any prizes.
This is Crocs you're talking about now, correct?
There's Crocs. Yep.
Yeah,
In
and this is
particular.
the other dynamic that people don't focus on. Managing money is they put you in a style box and you're a growth guy. And as soon as there's no growth, you get rid of these stocks and you've got to find a new audience. And it's never a pretty process, as we're seeing with this chart here. So now you got to find a value guy who likes Crocs? Maybe, but he's starting to like them today. But this is going to be a tough way to make money in a world where you have thousands of stocks. Why here?
Yeah. You have the Crocs shoes themselves are never going to biodegrade, and you still have the haters channels are stuffed from the last 2 years. And so that actually was an acquisition that kind of paid off for them. And again, you're talking about a company that's trading at 7 times next year's earnings. It's not a bottomless pit of despair, but as you said, they got to find a whole new shareholder base, because you need people that are going to buy into a turnaround at this beleaguered Hey Dudes brand and going to ignore that Crocs is due for a little bit of a reset year, just in terms of the growth that they've had, which is perfectly normal, no matter how popular these sandals are. And God knows I love them. It's a little pause refreshes every once in a while. You need to reset the customer base.
Yeah, I applaud you for saying, hey, the thesis has changed. Let's get out of these names, or at least lessen them and go fight some other wars. Again, this isn't a suicide pact.
It's not a suicide pact. And when the turn comes, as happened in coffee, Dutch Bros is still just doing tremendously well, but there's plenty of room. If Starbucks gets their act together, that stock has behaved terrific this year. The expectations are low. They've just spent some time and moved back and digested. You got to keep your money moving. You play these consumer names, it's 70% of GDP. It's going to be hard to move the needle as an entire space particularly very far. But in terms of stealing share on the margin, holy crap, that's what the game's all about. That Gap is going to take just a little share from Abercrombie, and that's going to fuel their stock for the year. It's these kind of stories ebb and flow, and it's a matter of being a little nimble. What else? Checking out Bakes. What do we got going on? It's Bob. You looking at anything else this morning? How are they opening? What's happening?
I do. And just to show you that we span the globe for the constant variety of sport, Highcroft Mining. I met Charlie Peabody, our bank analyst, and I said, okay, that's great, sleepy banks, and isn't that nice? But he talked about this, Highcroft Mining, a gold miner, back in December 9th on the show. We got it time stamped. So he's here at 226, I think is the number. And it is just right now taking off. We think this is the bank, the gold mine that AMC bought. And Charlie rightfully said that he got laughed at, not by me, Charlie, but some would say, I'm not going to buy AMC's gold mine. Are you out of your mind? But we are taking out this 294 level, and I sent this to the group last night, and now we're taking out new highs on 2.5 times normal volume. The relative strength line looks great. Obviously, gold is hitting new highs with a massive central bank buying, but now it's starting to come to the junior miners where you do have some operating leverage if you see the revenue line pick up the way it looks like it should if you're multiplying by a higher price. So this is Highcroft Mining. This is a joint venture between Charlie Peabody and Bakes, and I think this is starting to go into this previous high of 465. I think is absolutely reasonable, and I just want to show you this. Yeah, this is probably the AMC buy back here during that craziness. Clearly, the sentiment is washed out. The knife is on the floor. My thumbs and Charlie's thumbs are intact, and he's long here. And if I were individual names, I own the ETF AUMI, but gold is going north and Highcroft Mining is going north with it. And Charlie's a Renaissance man as far as I'm concerned.
You guys are the Deadpool and Wolverine of the investing space. It's a honor to be part of it.
I've been
it's also
called
a nice
worse.
way to get long some gold and avoid your movie exposure in general. What else we got going on today, boys? You got anything exciting going on for the rest of the week? What should we have on our radars?
Just a shout out, Maris isn't on the show, but Hims is blowing it out, HIMS, and it's more than a triple, more than worth the price of admission, keeping with my AMC theme. And in the face of a lot of fur flying and a lot of controversy, the bulls are right, Maris is right, and kudos to him. And keep an eye on Citi. We'll talk about that down the road. I'm going to tease you a little bit, but Charlie and I are talking about Citi, and I'll talk about it more down the road.
Hims has been a screamer, man. The strongest steel is forged out of the kiln of argument. And so I think the back and forth there honed it up to a fine point. But man, Hims been a monster. Bob, go on.
No, next 2 weeks are going to be busy for energy. We've got, other than the integrated, Exxon, Chevron, Conoco that are reported, we've got all the E&Ps over the next couple of weeks. So it's going to be interesting to watch those. The name I've highlighted that I like on the earnings numbers, EOG, CNQ. Still, if it dips below 30, we'd be backing up and buying CNQ below 30. Williams below 55.
How in tune are you to the weather on that
this weekend?
Yeah, we got Trump in Saudi Arabia, and we have storms just absolutely hammering apparently about 90% of the country right now. So does that matter? Or is that something that you just don't worry about?
Yeah, that's really lit another fire under natural gas, and natural gas is up here today. The near-month contract, 372. Natural gas continues to gain support. We've worked off the year-over-year storage overhang. Natural gas is looking pretty strong here, and so the names like Expand Energy, EQT are my favorite gas names. I keep trying to hope to get them a little bit cheaper here, but the weather, Mother Nature's working against me and continuing to keep the gas price up and support those names. So those continue. I keep our positions there. I was just looking to add to my positions there, but those are my two favorite gas names. Intero reported yesterday, nothing special there. I prefer Expand and EQT.
Hey, Bob.
Mother Nature and Father Time are legendary badasses, undefeated.
I think constructive. EQT, this is the deep sea swoon, and it knocked it down, I don't know, $6-7 from, call it 53 to 47, and it is completely coming off of that. You don't look for dips too long, I don't think. I think that if you get anything around 47, 48, 49, take it. And I know you don't like buying new highs, but Deep Sea kind of stress tested this for you.
Yeah, I don't think we'll see 47, 48, but you're right. I'd like to add to my position there, but we'll see how it plays out.
Yeah, and a beautiful example in more ways than one to skin a cat out there. Not many people were looking at EQT when Deep Sea came out. That was just a tech story. It's this, it's that, it's the other thing. Turns out you can make quite a bit of money doing the energy plays. So that worked out. Yet another benefit of this fine service of Wall Street Beats. Hey, I think that kind of wraps us up for the day. It's been my pleasure, guys. You just have a fantastic day. Let's make some money and tune in here, folks, if you want to hear more content along these lines, only even better sometimes. I'm Jeff Mackey. Have a great day.
See you, folks.